Hello, and a very good Monday morning to you. Welcome back to the Deep Dive. Today, we are tackling a financial paradox, really, something that's dominating every single conversation on Wall Street right now. We're going deep on what some analysts are calling the crisis inversa, or the reverse market crash.
It's a fascinating and, frankly, a terrifying idea. If you just glance at headlines, everything looks great, right? It looks euphoric. U.S. indices are hitting new records. The tech sector is just driving valuations into the stratosphere.
Right, all green arrows.
Exactly. But what our sources are suggesting is that this isn't genuine financial health. They're calling it a, quote, pathological distortion, a state of, unprecedented success that's paradoxically cranking up systemic risk.
That seems so counterintuitive, though. How can massive success actually lead to a crash? That's the paradox we're digging into. So our mission today is to unpack this phenomenon, this euphoric rise, often called the melt-up.
Right, and we'll analyze the quantitative data that points to a massive reversion to the mean event, which many are expecting around the 2025-2026 cycle.
And most importantly, provide some concrete, actionable strategies for you to protect and preserve your capital through all this volatility. Okay, let's unpack this.
The crisis inversa is, well, it's fundamentally different from the crash cycles that most investors probably remember.
Like 2008 or the dot-com bust?
Precisely. A traditional crash is a deflation of value. It's driven by fear, by panic, by falling prices. This crisis, though, is defined by what you could call uncontainable euphoria. You get this parabolic, purely speculative increase in prices.
And the key, I think, is the disconnect from reality. The prices completely detached from fundamentals like GDP growth.
Total disconnection. And that's the ultimate psychological trap. The whole thing is fueled by raw greed and that famous fear of missing out FOMO.
Of course. And the sources are really clear on this point. When the success becomes this excessive, it just silences all the skeptics. The money gets even more concentrated. You see things like short squeezes, which just pour gasoline on the fire.
And right now, the AI narrative is the perfect justification for any valuation, no matter how extreme it seems. It's the exact same kind of technological rationale we saw back in the dot-com era.
But hold on a second. The AI advancements, they feel real. They are real. Why isn't this just structural, justified growth?
Because structural growth doesn't typically move assets this fast, relative to historical norms.
Right.
We actually have models for this kind of pathology. The Austrian School of Economics, for example, they describe the crack-up boom.
The crack-up boom, right. That's where the fear of currency devaluation.
Exactly. It drives capital to flee cash. People aggressively pile into hard assets, into equities, creating massive asset inflation.
So it's not just the price of milk going up, it's the S&P 500 going up because the dollar is losing its perceived value.
Precisely. And then there's Hyman Minsky's hypothesis, which is critical here. He said, stability destabilizes.
Meaning a long period of calm makes people take bigger and bigger risks?
Yes. It pushes markets from cautious investment into the speculative phase, and then finally into the Ponzi phase.
The Ponzi phase. That's where you're just buying based on the greater fool theory. You don't care about earnings, you just assume someone else will pay more for it later.
That's it. And that final euphoric peak, where the market's only logic is its own momentum, that is the crisis inversa. It's so much more dangerous because the signal of the coming collapse is the market's own unprecedented success.
So the signal to get out is completely counterintuitive.
Completely. The market rises, hits that peak of euphoria and FOMO, and then the sharp collapse comes.
Okay, so if psychology is the driver, what's the fuel for this explosion?
Well, the analysis points straight to liquidity and the persistent assumption the Fed put.
The Fed put. The belief that the Federal Reserve will always step in and save the day.
It's a deeply ingrained belief. Our sources cite David Hunter, who argues the Fed might be forced into emergency rate cuts in 2025. And just the anticipation of those cuts could catalyze the final, most parabolic leg of this whole melt-up.
And that final run is what's so dangerous because it hides what's really going on under the surface.
Extreme internal dislocation. We're seeing unprecedented concentration in just a few names, the Magnificent Seven and other AI stocks. So the S&P 500 can hit a new high, giving this illusion of strength.
Well, the average stock, say in the Russell 2000, is actually lagging way behind.
It's a classic symptom of a really unstable market, a screaming red flag.
So if the price signals are psychological, let's nail down the quantitative evidence. Let's talk hard data. The Shiller-Cape-E ratio, it's oscillating around 40x right now.
40. This number it's probably the most crucial red flag you need to memorize.
40. And the historical average is what, 17?
A mere 17x. So to put 40x in context, the only precedent that was higher was the absolute peak of the dot-com bubble in 2000. That hit 44.2x. Even the 1929 crash was only 32.5x.
But I hear this argument all the time. Why should the old average of 17x still matter now? I mean, with AI and productivity changing everything, shouldn't we expect a permanently higher valuation? Maybe 30x becomes the new normal.
That is the optimist's key defense. It's a valid question, but history shows that every single technological revolution, railroads, electricity, the internet, was eventually followed by a massive reversion to the mean. Mathematically, just to get back to that 17x average, the market needs to drop more than 50% from where it is today.
A 50% drop. Wow, that really puts the risk into perspective. What about volatility? The VIX seems so calm.
It does, and that's deceptive. Look at the VIX, the fear gauge. It's been so low, often below 15. Low volatility sounds good, but what it really signals is extreme institutional complacency. It's driven by what they call the short volatility trade.
Where big funds are essentially betting that nothing bad will happen.
They're selling cheap insurance. But when the VIX suddenly spikes, they are forced to buy that insurance back instantly. That's what leads to forced deleveraging and a rapid, violent sell-off. The current calm is, in a way, setting the stage for chaos.
And finally, the yield curve. We all know the inverted 10Y 2Y curve signals a recession, but you're saying the immediate danger isn't the inversion itself.
Correct. The inversion is already priced in. The real danger, the countdown clock, begins with its normalization, the disinversion. When that curve rapidly uninverts and flips back to positive, it historically signals that the recessionary environment has become so severe the Fed is forced into emergency cuts. That normalization event is the final, definitive signal.
Before we dive into the fascinating, and I have to say, wildly divergent forecasts from Wall Street's top minds, let's just take a quick moment. Understanding all these mechanics, the CPE ratio, the VIX, it takes this kind of focused analysis, and we're so grateful you're spending your time with us. If you were finding this discussion valuable, we'd invite you to subscribe to the Deep Dive, leave a like, and maybe comment on what financial or economic themes you'd like us to tackle next.
We truly do appreciate your support. And also, just remember that in the description, you'll find two important links. One to our sponsor, Broker360, and another to PayPal if you feel like supporting this project directly.
Your contribution really does help us keep producing detailed content just like this. Thank you so much for your support. All right, here's where it gets really interesting. Given the record valuations and this clear dislocation, Wall Street is completely split on what happens next. We have three deeply diverging views for 2025-2026.
Okay, let's start with David Hunter. We could call him the contrarian extremist. His view aligns perfectly with the crisis inversa model. A spectacular melt-up, followed by a deflationary bust, an absolute bust.
And his targets for the melt-up are pretty spectacular themselves.
They are. Hunter sees the S&P 500 reaching somewhere between 7,000 to 8,000 by late 2025. That is massive upside.
But the cost of that final push is
a complete collapse. An 80% wipeout of asset value, he argues, which would return the S&P back down to the 1,500 to 2,000 range. His philosophy is simple. The bigger the bubble, the bigger the pop.
80%. That is an apocalyptic scenario. Okay, moving to the other end of the spectrum, we have Jeremy Grantham, the super bubble historian.
Right. Grantham is less concerned with the daily AI hype and more rooted in studying these long-term financial cycles. He believes we are already in the super bubble's final act. He sees very limited upside left, if any.
So his view is that valuations just have to return to the historical norms. No exceptions.
Exactly. He sees the AI narrative as just a classic bubble within a bubble, and he's projecting a severe correction that brings the market back to its historical mean. That would imply a fall to around 3,200 for the S&P.
And finally, the structural optimist Ed Yardeni. If Hunter is the apocalypse and Grantham is regression, Yardeni is technological transcendence.
A great way to put it. Yardeni is all in on the roaring 2020s thesis. He genuinely believes that AI-driven productivity is a game changer that validates these higher valuations. He's targeting the S&P 500 at 6,000 to 7,000 in the next couple of years, with a shot at 10,000 by the end of the decade.
So for him, that historical 17x average is basically obsolete now because of technology.
That's his core premise. But, and this is important, even Yardeni, the biggest optimist, has to concede the danger of a crisis inversa. He admits that if the market goes on an uncontrolled vertical run, that parabolic move we talked about, it dramatically increases the risk of a severe, sharp correction. So really, the consensus among all three, despite their wildly different targets, is that extreme volatility is coming.
If we connect this to the bigger picture, the average investor is facing this incredibly asymmetric situation.
Right. There's explosive upside on one hand, but it's paired with the risk of, well, financial ruin on the other. So the whole mandate has to shift. The goal can't be maximizing your return. It has to be capital preservation.
And that leads us to the barbell strategy. You avoid the lukewarm middle and position at two extremes. So how do we approach extreme A, capturing some of that melt-up, but safely?
Extreme A is about tactical exposure to those momentum sectors, tech, AI, semiconductors. But you have to do it with surgical precision. Discipline is paramount. You have to use dynamic stop-loss orders, also known as trailing stops.
Can you just break down quickly how a trailing stop works for someone who might not use them?
Certainly. Let's say you buy a stock at $100 and it runs up to $150. A trailing stop might be set at, say, 10%. If the stock then drops 10% from its highest point, so back down to $135, the order automatically sells your position. It lets you rent the momentum, you participate in the rise, but you are not buying and holding it all the way down to zero. You need an automated exit.
It sounds like a great way to manage your own greed and FOMO. And extreme B is the insurance policy. Protection against the bust. So liquidity and hard assets.
Precisely. Gold and silver. They remain the ultimate stores of value when confidence in fiat currency starts to wobble. Some analysts are projecting gold in the range of $3,000 to $5,000 an ounce in this cycle, driven by huge central bank buying and geopolitical risk. A structural allocation of 10 to 20% in precious metals is just a prudent hedge.
And cash. How does cash become an asset in this kind of scenario?
Cash, or T-bills, becomes the most valuable asset you can own during a collapse. When a crisis hits, liquidity dries up, credit freezes, and only cash gives you options. It allows you to capitalize on the disaster by buying great asset stocks, real estate at fire sale prices.
Before we wrap up, let's just reinforce the triggers. What turns this from a melt-up into a bust?
Well, the most terrifying potential trigger is a global banking crisis. This one would likely be fueled by the mountain of toxic commercial real estate debt and other leveraged corporate debt out there. It could make 2008 look small. That kind of shock would trigger forced deleveraging, margin calls, and asset correlation would go to 1.
Wait, asset correlation goes to 1. What does that mean for the everyday investor?
That means everything sells off at the same time. The Magnificent Seven, the Russell 2000, Bitcoin, corporate bonds, you name it. Your traditional diversification strategy completely fails because institutions are just forced to liquidate everything to raise cash.
Which makes those exit signals even more vital. What are the 3 tactical signs to watch for?
First, the rapid normalization of the yield curve. If that 10Y2Y spread suddenly flips positive, that's the technical signal the recession is here. Second, watch market breadth divergence. If the S&P is making new highs, but fewer and fewer individual stocks are participating in that rise, the rally is a facade. It's hollow.
And the final warning from the credit markets.
The widening of credit spreads. Watch how high yield or junk bonds are performing relative to safe government bonds. When that spread widens, it means the credit market, the true lifeblood of the system, is under severe stress. And the stock market is probably next.
So what does this all mean? It means the crisis inversa is real. It's validated by historical metrics like the IPA ratio. And the key to success isn't maximizing every last dollar on the way up, but having the surgical precision, the tools like trailing stops, the strategic liquidity to preserve your capital during the inevitable bust.
And that leads to a final, provocative thought for you to consider. Let's say David Hunter is right. The S&P 500 hits 8,000, but at the same time, gold hits $5,000 an ounce. What does that really tell you about the future purchasing power of the dollar? You might have huge nominal gains in your brokerage account, but if the dollar has lost 60% of its value in real terms, the game has fundamentally changed. It's no longer about growth, it's about the fierce preservation of value.
And on that very sobering thought, we reach the end of today's deep dive. We sincerely hope you enjoyed this exploration, that you learned something new, and that you'll join us for the next one. Remember, you'll find a link to PayPal in the description if you'd like to help us out. Thanks again.
Thank you so much for listening.
Thank you, and we'll catch you very soon.